Good morning and welcome to this week's edition of Winston's Weekly, covering things all property. I'm Paul Sanger, your host for today's Property Chat. Winston, welcome back.
Thank you.
Now, Winston, let's dive into what's been happening in the US markets. US equity markets have continued their rally this week, with the S&P 500 now just 1% away from its all-time record close. Several data points this week, including the minutes from the July's FOMC meeting and revised job data, offered few surprises, and they largely reaffirmed that inflation is moving in the right direction, though concerns about the employment situation remain elevated. Traders are also now pricing in a 100% chance of a 25 basis rate cut next month, and some outliers are even speculating there could be 50 basis points cuts could be possible. Keen to get your thoughts on both these topics.
Yes, well, I think there's a reflection of the positive sentiment about rate cuts, with the 10-year bonds in the US now down to 3.8. Here in Australia, they're 3.9. And expectations are that there definitely will be a cut of at least 25 basis points. And I think because of the uncertainty about the jobs data and so on, it's unlikely to be 50 basis points in the one hit. And that gives them room to move a little bit later on, rather than put all that in basket and cut 50 points. So I think the stronger equity market and the bonds where they are does indicate that there will be a cut of 25 basis points in the September announcement.
Okay, now let's shift our focus to the domestic markets. This week, the minutes from the central bank's August 5th, 6th meeting reaffirmed that any rate relief is unlikely here in Australia to materialise until 2025. And then also, following the Reserve Bank's decision to lower the official cash rate last week, 3 of the 4 major banks have announced cuts to some of their fixed mortgage rates and certain term deposit rates as well. I'm eager to hear your thoughts on this, Winston.
Well, as we know, the banks want to make as much money as they can, and so they reduce the rates that they're paying out, but I don't think they reduced the rates on loans at this stage. So there is a bit of a dichotomy there. Again, the fact that the RBA has basically said there's no rate cut this year just does push out the prospects until 2025. And I think markets are now feeling a bit more comfortable with that. We are in a different environment, obviously, than the US, with inflation still being very sticky and at the upper end of the threes. So it doesn't augur for a rate cut in the immediate short term.
Yeah, and you've been pretty consistent with that view over the last 3 or 4 months, to be fair. Okay, let's move into domestic property news. Let's start with Dexus released its full year results earlier this week, and the market clearly reacting quite negatively. The reasons I could see, the combination of significant asset write-downs and a weak outlook for the FY 24-25, and coupled with an expected distribution of 37 cents per share, which is a 23% drop from the previous year's 48 cents per share, was not well received. What's your take on these numbers, Winston?
Well, I think you're right in terms of highlighting the cut in the distributions, dividends. It's a reasonable sort of a cut, and it was unexpected. I think, well, the way Dexus has approached this result is that they've taken like the lower end of market expectations. Now, whether they think that by doing that they sort of cleared the decks and they can deliver some better numbers as time progresses, if things do work in their favour, but I think people were disappointed with the cut that they undertook, and that's the main reason why the stock suffered as a result post the announcements.
Yeah, clearly a risky strategy that in the short term doesn't look like it's paid off. And Winston, on the other hand, Charter Hall also released its results this week, and that led to nearly a 15% surge in the stock price. What's your take on these numbers? What do you think drove this significant positive move?
Well, as I mentioned, with regards to Dexus, they took the bottom end of the road. Charter Hall has taken the top end, and their forecasts and expectations sort of exceeded market expectations. But you have to remember, well, first of all, the cap rate that they've applied is 5.7%, which is actually lower than either Mirvac's or Dexus's cap rate that they've applied. Number one. Number two, a lot of what's driving or what drove the share price is the earnings guidance, which was higher than the market was expecting, and that's based on the outlook, which Charter Hall is painting, that interest rates are going to come down, albeit not this year, and that there'll be increased activity in terms of transactions. They're sort of focusing on buying and developing, I won't say state of the art, but modern buildings, and getting rid of some of the lower quality assets that they hold, so that they're improving the quality of their overall portfolio. Now, I guess some of that remains to be seen as to whether that does play out. Also, what they highlighted was that fund flows into their funds has been fairly benign, and they're expecting that to grow. Again, that's, I suppose, it's on a wish and a prayer if that does actually happen. So they're looking at all the positives rather than the way that others have looked at, Dexus in particular, looking at the lower end.
And any other stocks in your sector caught your eye this week?
Well, we're now pretty well at the end of the results period, or the majors anyway. No, again, realistically, the sector's done reasonably well. Mirvac and Dexus were two that the market were disappointed with, and they've suffered as a result, whereas Charter Hall was one that was positive. We've had Scentre, we've had the retail stocks, Scentre and Vicinity, were well received, notwithstanding hiccups with issues of cost of living and spending and so on. But I think the focus needs to continue in the short term to non-discretionary spending as well. And see, this morning Stockland have released their result, which is a little bit ahead of expectations, and we'll need to go through those numbers to see. I mean, I guess if rates do come down, when they do come down, that the resi market will look to pick up a little bit. So that might be a positive for Stockland in the long run.
Gotcha. And look, yeah, the key focus this week is the Fed's annual conference in the US on Friday in Jackson Hole. Do you anticipate any surprises from the Fed Chairman Jerome Powell?
No, I think he'll continue to toe the line. That expectations are. And the numbers seem to indicate that inflation seems to be coming down, and it's a matter of how much conviction they have in terms of the employment numbers, looking in the rearview mirror, as it were. And I don't think he'll say anything that's untoward or that will rattle the market. So it's probably more of the same to come.
Yeah, no, I don't disagree with you. And then looking forward to next week, Winston, what should we be expecting on the property front?
Well, I think what will happen now is, as I said, we're at the end of the reporting period. It'll be a matter of reassessing where people see the growth prospects in property, the rental outlook, management comments on the outlook going forward for them. So I think that next week will be some decision making as to people might want to switch exposures, particularly in the property subsector asset class, whether they want to pick up a little bit more retail. One thing that has been evident over the last 3 or 4 weeks is that Goodman Group, even though it did release a good result, has actually been weaker over that time frame. And that's maybe a function of the fact that it's had such a big run over such a long period of time. People are taking profits and looking to deploy those funds elsewhere within the sector.
Gotcha. Winston, thanks for your time and your insights as always. We will be back next week with another edition of Winston's Weekly. You have a great day. Thanks to everybody.